The auto sector, the transportation sector, and the logistics sector probably have the most important roles to play in the growth story of the world's fastest growing economy, that is Apna Bharat. These sectors are cyclical in nature, which means investing into them at the wrong time would result in big losses for investors. However, if the entry and exit are rightly timed, investors can make big money within just a few years. In this video, we are going to discuss what opportunities lie ahead for retail investors in these kinds of stocks, what risks are associated with them, and most importantly, how to not lose money in them. Namaste and welcome to another brand new episode of Retail Investing. So first, let's understand the basics of cyclical companies. There are some companies whose sales go up and go down in regular intervals. These intervals may be regular but not easily predictable because they are closely connected to macroeconomic developments which themselves are almost impossible to predict. Some sectors in this category are the automobile sector, the tire sector, the steel sector, and the airline sector. It is very easy for inexperienced investors to lose money in cyclicals. And let me explain how. Most cyclicals are big and well-known companies. For example, Tata Steel has a history of more than 115 years in nation building. Any new investor would consider it a safe investment. If you look into the 10-year sales figures of Tata Steel, you will notice that it fluctuates crazily, and so does the price of its stock. Buying at the wrong time would mean getting trapped for many years. To make money in cyclicals, three things must be thoroughly studied. Investors need to study what is happening with the company's inventory. Is it increasing too much? A large inventory could mean that demand is slowing down. If demand keeps going down and inventory keeps piling up, that could mean that the new inventory would have to compete against the old inventory, and that would adversely affect the price. And inventory growth faster than sales growth is a red flag. This would ultimately result in the stock's crash. If new players successfully enter the market, it could be dangerous for existing players in a cyclical industry. So investors must look for new entrants before buying these kind of stocks. The PE ratio for cyclical companies is very tricky to understand. A separate video would be required to explain the concept properly. But in this video, I'll try to explain the concept in short. In cyclicals, as business recovers, the PE ratio is expected to go down. The exact opposite happens with growth stocks. In growth stocks, PE expansion happens when the business is expected to give good quarters in the future. So for cyclicals, there would be situations in which investors might need to invest at high PEs to make profit. I hope that did not confuse you. There are many kinds of cyclicals, but some sectors like the auto sector, the transportation sector, and the logistics sector are often called the barometer sectors. Now, what exactly is a barometer sector? A barometer is an instrument which measures atmospheric pressure and is used for weather forecasting. In the world of finance, barometer means something which represents the trend or sentiment in the general economy. When the overall economic activity of India increases, it will get the most reflected in these three sectors, the barometer sectors. This also means that when the economy gets crushed, that too will also get reflected the most in these three sectors. In 2020, the economy got totally crushed thanks to the COVID virus. And these three sectors took the beating because these sectors have no role to play in an economy which is under lockdown. A lockdown is a great time for IT and tech companies, and those companies performed well. The situation has totally changed since the lockdowns. Logistics activities are already higher than what they were at pre-COVID times. What is even better is that these sectors, especially the logistics sector, are in the early stages of recovery, an ideal time for entry. The Russia-Ukraine war cannot continue forever, which means commodity prices are going to come down. So with lower crude oil prices, it's obvious that profit margins of logistics companies are going to improve. But improvements in profit margins alone cannot generate multi-bagger returns. There has to be massive growth in sales volumes as well. So what are the chances of increase in sales volumes? Well, private capital expenditures are going up in these sectors and new production facilities are being set up. A lot of that is happening due to various government policies like the PLI or the Production Linked Incentive Scheme. The Indian road infrastructure has already become world-class and great steps are being taken for improving inland waterways and freight corridors. The Union Ministry of Commerce and Industry has set a target of $2 trillion of exports by 2030. $2 trillion US used to be the size of our entire economy not so long ago. How can the government expect to achieve such an ambitious target without the help of the auto sector, the transportation sector, and the logistics sector? For these reasons, I can bet my money on the transportation and the logistics sector. Now let's have a look at some data to support all these big claims of mine. So this graph shows the performance of the Nifty 50 in the yellow line, the auto sector in the blue line, and the transportation and the logistics sector in the red line. This graph shows the performance of the last 3 years. In the last 1 year, the Nifty Auto Index has gone up by 30% compared to only 13% of the Nifty 50. The outperformance of the transportation and logistics sector is even bigger, as it can be clearly seen in the graph. It is never wise to invest without proper risk analysis. So let's have a look at the potential risks for investing into these sectors. Geopolitics is unpredictable. What if another war breaks out? What if China decides to invade Taiwan? Crude oil prices might skyrocket in such a situation, and the profit margins of logistics companies would definitely suffer. Now, what is the actual possibility of that happening? It is up to each individual investor to decide before investing. Changes in government regulations is a potential risk for every industry. But as per my understanding, adverse effects of government policies on these barometer sectors are unlikely to happen. The Honorable Union Minister for Road Transport and Highways has made a promise that Indian road infrastructure will match American standards by the end of 2024. And he has been clearly delivering on that promise so far. So who is going to benefit the most from a world-class road infrastructure? In the medium term, the transportation and logistics companies for sure. Great businesses may not always be great investments. That's because the speculators and their FOMO often make these businesses highly overvalued. As a retail investor, I would never invest in a great business at the wrong valuation. That is the concept of margin of safety. And the final risk is what we have already discussed earlier in this video. The cyclical nature of these businesses make them risky bets for inexperienced investors. The only possible way to make profits in these stocks is to enter and exit them at the right time. So I did not name any specific stocks in this video because that would have made the video very long. Stock analysis takes its own time. If picking individual stocks in these sectors seems too difficult, which it is, there is always the option of investing through mutual funds. There are some thematic funds, the transportation and logistics funds, which have generated wonderful returns in the recent past. I won't name any of them. Please do your own research. Thank you very much for watching the video and have a nice time. I will see you in the next one.